For beginners in the United States, investing in 2026 can feel overwhelming. Markets move fast, headlines are dramatic, and social media often pushes risky ideas disguised as shortcuts to wealth. For someone just starting out, the real goal is not quick gains, but safety, stability, and steady long-term growth. The safest investment for beginners is not a single product or trend. Instead, it is a simple, disciplined approach built around real ownership, diversification, patience, and consistency. The foundation of safe investing is understanding that wealth is built over time. Beginners often believe they must predict the market or find the next big opportunity. In reality, the safest path is focusing on investments that represent ownership in real economic activity and spreading risk across many assets. This approach reduces the chance of major losses while allowing your money to grow alongside the broader economy. One of the safest and most beginner-friendly investments in 2026 is diversified ownership in productive businesses. When you own a small portion of many well-established companies, you are not relying on the success of a single idea or industry. You are participating in the growth of the overall economy. This reduces risk significantly compared to betting on individual companies or speculative trends. For beginners, broad market exposure is key. Instead of trying to choose winners, you invest in a wide range of companies across sectors such as technology, healthcare, manufacturing, consumer goods, and energy. This means that if one sector slows down, others can help balance performance. Historically, diversified ownership of productive businesses has shown resilience through economic cycles, inflation, and market volatility. Another important element of safety is simplicity. Complicated investment strategies often increase risk because they are harder to understand and manage. Beginners benefit most from clear, transparent investments that are easy to track. When you understand what you own and why you own it, you are less likely to make emotional decisions during market ups and downs. Consistency is another pillar of safe investing. Rather than trying to invest a large amount at once, beginners can invest regularly over time. This approach smooths out market fluctuations and reduces the risk of entering at an unfavorable moment. In the U.S., many investors use automatic monthly contributions to stay disciplined. Over time, this habit builds momentum and reduces stress. Safety also comes from avoiding speculation. Speculation is driven by short-term price movements, hype, and fear of missing out. In contrast, safe investing focuses on long-term value and real-world productivity. Beginners should avoid chasing trends, viral stocks, or promises of fast returns. These approaches often expose investors to sharp losses and emotional burnout. Another safe investment principle is maintaining liquidity. Beginners should not invest money they may need in the short term. Keeping a portion of funds easily accessible provides financial stability and peace of mind. This buffer allows investors to stay invested during market downturns instead of being forced to sell at a loss.
Education is also an investment, and it may be the safest one of all. Learning how markets work, how businesses generate value, and how long-term growth happens helps beginners make better decisions. In 2026, there is no shortage of educational resources available to U.S. investors. Understanding basic financial principles reduces the risk of falling for misleading information or unrealistic expectations. Real assets also play a role in a safe investment strategy. Assets tied to tangible value, such as property used for living or productive purposes, have historically provided stability over time. While not everyone can invest directly in real estate, understanding the value of asset-backed investments helps beginners think beyond paper gains and focus on real-world usefulness. Diversification should not stop at asset type alone. Geographic diversification adds another layer of safety. The U.S. economy is strong, but global exposure allows investors to benefit from growth in other regions while reducing reliance on any single market. A diversified approach spreads risk and increases resilience. Another key aspect of safety is long-term thinking. Market volatility is normal, and short-term declines are unavoidable. Beginners who understand this are less likely to panic. Historically, patient investors who stay consistent and avoid emotional reactions tend to achieve better outcomes than those who constantly react to news and market noise. In 2026, technology continues to make investing more accessible, but ease of access can sometimes encourage impulsive behavior. Safe investing requires intentional decision-making. Beginners should take time to define their goals, risk tolerance, and time horizon before investing. Clear goals provide direction and reduce the temptation to take unnecessary risks. It is also important to measure success realistically. Safe investing is not about doubling money quickly. It's about preserving capital, growing steadily, and building financial security over time. Small, consistent progress compounds into meaningful results over the years. Beginners who focus on this mindset are more likely to stay invested and avoid costly mistakes. Another often overlooked factor in safe investing is alignment with personal values. When investments align with ethical principles and real economic value, investors feel more confident and committed. This reduces stress and strengthens long-term discipline. Investing should feel sustainable, not uncomfortable or confusing. Risk management is central to safety. This means regularly reviewing investments, rebalancing when necessary, and avoiding overexposure to any single asset. A balanced approach ensures that growth does not come at the cost of excessive risk. Beginners do not need complex strategies to manage risk. Simplicity and awareness are enough. The safest investment for beginners in 2026 is not about predicting the future. It's about building a strong system that works in most conditions. A diversified portfolio, consistent contributions, long-term patience, and ethical ownership form a powerful combination. This approach protects beginners from major losses while allowing them to participate in economic growth. Ultimately, safety in investing comes from behavior more than products. Staying disciplined, avoiding emotional decisions, and focusing on long-term value are what separates successful investors from frustrated ones. Beginners who adopt these principles early give themselves a strong advantage. For the U.S. audience in 2026, the safest investment is a thoughtful, diversified, and values-driven approach to ownership in productive assets. It may not be flashy, but it is reliable. Over time, this approach builds confidence, financial stability, and lasting wealth.